UAE Corporate Tax, the complete beginner masterclass. Hello and welcome to CandiMentor. Today we decode UAE Corporate Tax, the tax system that changed business reporting across the Emirates. If you work in accounting, audit, finance, FP&A, tax advisory, or want to build a career in the Gulf, this guide walks you through UAE Corporate Tax from zero. Before we begin, hit subscribe to CandiMentor. What UAE Corporate Tax is: a modern, simple system. UAE Corporate Tax became effective for financial years starting on or after 1st June 2023. Its purpose is to align the UAE with global tax standards while remaining business-friendly. The headline features are simple and easy to remember. The standard rate is low, and there is a clear tax-free allowance for smaller profits. Key anchor: UAE corporate tax applies a 9% rate on taxable profits above a threshold. The first AED, $375,000, is taxed at 0%, and income above that is taxed at 9%. Who is subject to UAE corporate tax? Corporate tax applies to UAE companies and establishments, foreign companies with a permanent establishment in the UAE, free zone companies subject to qualifying conditions, individuals only when they carry on a licensed business activity, certain partnerships depending on legal form, branches of foreign entities that operate in the UAE, government and government-owned entities when they carry on business activity. Non-residents are taxable only on income from a UAE permanent establishment or specific UAE-sourced income. Tax rates: the simple structure. The UAE uses a tiered approach. 0% on the first AED $375,000 of taxable income. 9% on taxable income above AED $375,000. Separately, very large multinationals may be subject to a higher global minimum tax under international Pillar 2 rules. This straightforward rate structure makes the jurisdiction easy to understand for beginners. How taxable income is calculated. Start with accounting profit. Taxable income begins with accounting profit prepared under IFRS or the applicable accounting framework. From accounting profit, you make adjustments for items such as exempt income, non-deductible expenses, capital allowances, transfer pricing adjustments, and other tax-specific rules. Summary: taxable income equals accounting profit plus or minus statutory adjustments. SON. Exempt income: what often escapes tax. Several income types can be fully exempt under the UAE rules. Dividends from qualifying shareholdings, profits of qualifying foreign permanent establishments, qualifying intra-group transactions, gains on qualifying disposals of shares. These exemptions make the UAE attractive for holding companies and regional structures, but qualifying conditions must be met. Deductible versus non-deductible expenses. Common deductible items include salaries, rent, utilities, depreciation for tax, capital allowances, cost of goods sold, business travel, and broadly business-related costs. Non-deductible items commonly include fines and penalties, bribes, dividends, personal expenses, and certain entertainment costs. Some related party impairments have restricted deductibility. A practical rule: deductibility depends on whether an expense is wholly and exclusively for the business. On. Interest deductibility: the 30% rule. Interest is generally deductible subject to a cap. The usual cap limits interest deduction to 30% of tax EBITDA, with some exceptions for small entities and banking institutions. This rule helps prevent excessive interest-based profit shifting. Capital allowances, tax depreciation rules. Tax depreciation follows capital allowance schedules which differ from IFRS depreciation. Assets are grouped by category, and each category has prescribed allowance rates. For example, A 20% tax allowance yields a AED 20,000 deduction in year 1 for an AED 100,000 asset. Expect capital allowances to replace IFRS depreciation when computing taxable profit. End. Free zones, conditional 0% regimes. Free zone entities can retain 0% tax on qualifying income if they meet substance and activity tests and comply with reporting rules. Qualifying activities typically include manufacturing, export-oriented services, headquarters functions, and certain holding activities. Non-qualifying income is taxed at the standard rate. Important: free zone benefits are not automatic. Entities must satisfy adequacy of substance and other conditions. Transfer pricing. Arm's length rules apply. The UAE implements OECD-aligned transfer pricing rules. Related party transactions must be on arm's length terms. Where thresholds are met, taxpayers should prepare master file and local file documentation and be ready to justify pricing, allocation of costs, and intercompany financing arrangements. Common related party issues: management fees, royalties, intercompany loans, and distribution agreements. Reliefs and incentives. Useful practical mechanisms. Key reliefs include small business relief for qualifying small taxpayers, group relief allowing loss transfers among eligible group members, tax-neutral treatment for many intra-group transfers if conditions are satisfied, business restructuring relief enabling tax-neutral reorganizations. These reliefs are widely used in restructurings and cross-border planning. Tax losses carry-forward rules. Tax losses can be carried forward indefinitely in the UAE, but utilization is limited to 75% of taxable income in a given year. Loss carrybacks are generally not permitted. Losses may be restricted following changes in ownership. This treatment matters for startups and turnaround scenarios. Permanent establishment. When non-residents are taxable. A foreign company becomes taxable in the UAE when it has a fixed place of business or a dependent agent who habitually concludes contracts, or a construction or service project exceeding specified time thresholds. PE rules follow OECD guidance and determine whether a foreign enterprise is subject to UAE tax on local profits. Withholding tax, zero rate advantage. The UAE applies no withholding tax on payments of dividends, interest, royalties, or service fees to non-residents. This zero withholding rate is a major competitive advantage for flows from the UAE to other jurisdictions. Filing and compliance. Registration and deadlines. Taxpayers must register for corporate tax, file annual returns, keep proper books and records, and, where applicable, prepare transfer pricing documentation. Annual returns are generally due within 9 months of the taxpayer's financial year end. Payment of tax follows the return and agreed installment rules. Example: a company with year-end 31st December typically files by 30th September the following year. Accounting standards. IFRS basis. Tax computations are based on accounting profit prepared under IFRS or the applicable local accounting framework for eligible small entities. That alignment simplifies tax to accounting reconciliation, but still requires tax adjustments. CB. Numerical example, straightforward calculation. Accounting profit, AED 900,000. Disallowed expenses, AED 50,000. Taxable income, AED 950,000. Tax calculation. First, AED 375,000 at 0%, AED 0. Remaining, AED 575,000 at 9%, AED 51,750. Tax payable equals 51,750. Use short work numbers for clarity and TTS delivery. Standard. Journal entries. Simple narrative. Recording current tax liability. Debit income tax expense. Credit tax payable. When settling the liability, debit tax payable, credit cash. Deferred tax follows IAS 12 rules when temporary differences arise from accounting versus tax treatments. Common interview and classroom questions. Practice short replies. Prepare succinct answers for: what is the UAE corporate tax rate? How is taxable income computed? How do free zones work? What qualifies as exempt income? Explain transfer pricing obligations. What is a permanent establishment? Is withholding tax charged on outbound payments? How do losses carry forward? Aim to respond in one clear paragraph for each. End. Final wrap. What to remember. UAE Corporate Tax is modern, transparent, and business-friendly. Start with accounting profit. Apply statutory adjustments. Confirm free zone status for qualifying income. Respect transfer pricing rules, and calculate 9% on income above the AED 375,000 allowance. Keep documentation, meet filing deadlines, and use the reliefs carefully. If you found this useful, subscribe to CandiMentor. We're building a practical learning hub for accounting, finance, and tax, and you should be part of it.